With a range of forces putting a lid on growth, the Fed, protectionism, populism, what are public plan investors to do? In this session, Ronald Temple, Managing Director and co-head of multi-asset and head of U.S. equities at Lazard Asset Management, will share his perspectives on the global outlook as well as the asset allocation responses that might serve investors well.
Thank you. Thank you and good morning. It's great to be here with you today. So I'm going to go cover quite a bit of territory in the next 45 minutes. For the first 30 or 35 minutes, I'm going to cover my views on the global macroeconomic outlook. And then for the next 10 minutes after that, I'm going to talk about asset allocation and how you might want to respond to this low-growth world as you think about investing. And hopefully we'll have a few minutes left over for questions at the end. Now, before I start, I just want to point out, at Lazard, we have purposely chosen not to have a single house view. So what you'll hear today are my opinions, not necessarily the opinions of the overall firm. And point number two is I do plan to skip a number of slides. We included some extra material, thinking it might be useful reference material when you leave the conference. So please forgive me in advance if you see a slide flip by you quickly. Now, maybe just to start off, we chose the title Investing in a Low-Growth World because growth indeed is likely to be low for the next few years. What we're showing on this slide are actually the consensus growth rate expectations for each major economy. And what you see at the very top of each column is the size of each economy in US dollars for the full year of 2018. Now, in the US, you can see a downshift in growth from 2019 to 2020. You also see a nice gradual decline in China over the next few years. And across most other economies, you see relatively stable growth rates. Now, I'm going to start with the United States, though. I believe the US is now in the third phase of the growth or the expansion. Now, I tend to characterize the three phases as number one, from 2009 to 2011, we had a growth cycle characterized by quantitative easing, fiscal stimulus from the federal government, and the bank recapitalization. So you might want to think of this as a period when we basically stabilized the foundation for growth. Then from 2012 to 2014, in phase two, we had more QE. We had corporate profits recover, and we had wealth effects as the value of financial assets went up, people felt more confident in their balance sheets and would spend more. Now, what was missing in the first 5.5 years of this growth story was the middle-class consumer. We had to dig out of such a deep hole in terms of the labor market that wage growth was lower than inflation, home prices did not start to rise until 2012, and effectively a large part of the country was left behind. I believe the third phase of the expansion is all about that group of people, the middle class, and I think it kicked off around 2015, and I'll go through that in the slides that follow. Now, my outlook for the US, by the way, is growth of 2 to 2.5% this year, slowing down to around 2% next year, and I do not see a material risk of recession in the next 18 months, if not longer. And by the way, one last point on that, given how abnormal the global financial crisis was and the recovery thereafter, I think the US could actually post 3 to 5 more years of growth if the Fed doesn't basically hit the brakes as we thought they were going to do about 8 months ago. So it's a pretty positive story, albeit somewhat muted growth. Now, I always like to start off by assessing the balance sheet of the nation's household because that's who spends the money. And what you see here is household net worth in the US is $104 trillion. The all-time high, by the way, was at the end of the third quarter before we had the downtick in the markets at the end of the year. That was $108 trillion. The important thing to know is we're up $48 trillion since the first quarter of 2009, meaning we're 84% above that trough. Now, I take a somewhat unorthodox approach to economics, and I typically like to show these aggregate numbers, but then really peel back the onion. And the reason why is this. Let's use this anecdote. If Warren Buffett were in the room today, our average net worth per person would be $200 million. Really not a useful stat, right? So what I want to do in the next number of slides is go through and think about where this money is in society. And actually, one of the most important parts is here. 38 trillion of that $48 trillion increase in net worth has been financial assets. So what's included in financial assets? If you think of your own balance sheet, if you own a house, a car, durable goods that you can sell, those are physical assets. Pretty much everything else you can sell, including if you own a small business, is a financial asset. Important thing to know, financial assets are 80% of the increase in household net worth in the last 10 years. And as you can see in the text on the graph, 92% of all financial assets in the US are owned by the richest 25% of households. So those households own the bonds, the stocks, and they own almost all of the private businesses that you would think of on a day-to-day basis. The other 20% of the increase in net worth has been residential real estate. So what you see in light gray here is the value of housing assets. The black is the mortgage debt against those housing assets, and the blue is your owner's equity, so the net of the two, which is $15.5 trillion. And again, just for context, $15.5 trillion of equity in housing, $85 trillion in financial assets. Just the magnitude of the difference is huge. But the reason housing is so important is that's what the middle class owns. If you look at the households ranked from the 25th to the 75th percentile by net worth, on average for those households, 59% of their assets are their house. So housing really drives the story for the middle class. And this is one of those slides I mentioned for reference you'll get after the presentation. But what we've done here is looked at a Fed survey they do every 3 years, and we've ranked households by net worth to show you in the far right column the top 10% of households. If you're in that group, on average, you're worth $5.3 million. The brown box is around the middle class, where on average, the middle class households are worth $124,000. Interesting stat, by the way, to be in the 25th percentile, so you'd be richer than 31 million households in the US, you had to have $10,000. So 31 million households in America had less than $10,000 in 2016, and the pie charts show you how their assets break down. Now, this chart takes the same data set and gives you a time series. So again, the survey's every 3 years, and what we've done is rebased all of the data to 2007 and inflation adjusted it. So I want to focus your attention on the black line. That shows you the net worth of the median household in the US, so half are richer, half are poor. And you can see from 2007 to 2014, the median household lost 40% of their net worth in the housing crisis. Now, the good news is those lines have all turned upward, and they're now back to 70% of their net worth. But 9 years later, the median household is worth 30% less than they were in 2007, net of inflation. The orange line gives you the median household in the 25th to 50th percentile, so you could think of that as the middle of the lower middle class. They were actually down 49% from 07 to 13 and are still down 37%. So the reason I highlight this is the aggregate numbers look great, but a lot of it has been skewed to the top end, and you can see the black line shows you the median household in the top 10% is the only part of the chart that's back above sea level versus 07. Now, the good news is this is 16 data. In the last 3 years, house prices have gone up more, equity prices have gone up more, and bond prices have gone sideways. So all of these lines continue to move in the right direction. Now, I mentioned for the first 5.5 years of the recovery, what was missing was the middle class. The biggest driver for the middle class balance sheet is housing, but clearly the income statement is all about, do you have a job and are you getting raises? And this is where I think the story gets better. Now, this chart just shows you non-farm payroll growth in the United States since 2004. This recovery, as of next month, will be the longest expansion in US history at 10 years. And it's actually pretty phenomenal. I think it's easy to get numb to these numbers. But since 2011, for the last 8 years, we have generated, on average, about 200,000 jobs per month in the non-farm sector pretty continuously through that period. So this has been an incredible period of job creation in the US. Obviously, after the decline in the financial crisis, we were losing 800,000 jobs in a single month. This is very positive. But what had happened, as I mentioned earlier, we had to dig ourselves out of such a deep hole after the crisis that wage growth really didn't respond. So what you see here in gray is the Atlanta Fed wage tracker. In blue, average hourly earnings. And in gold, the employment cost index. And we include 3 different indices because each one has its own vagaries. In the black line, we average the 3 together. And you can see from 2010 to 2014, that black line just basically bumped along between 1.5% and 2% wage growth. Inflation was 1.5% to 2%, so you had no real wage gains at all for 5 years. From 2014 onward, we ground up towards 3%, and now we're just over 3.25%. I think in the next 1 to 2 years, we'll be between 3.5% to 4%. If inflation stays relatively tame, that means your real wages are finally starting to grow, and I think that, by the way, puts pressure on companies to invest in capital expenditures to increase the productivity of labor to offset that wage pressure, which could extend your recovery by several more years potentially. Now, part of my optimism is based on this survey. It's the Job Opening Labor Turnover Survey. It's the JOLTS data. The left chart shows you the percentage of jobs in the US that are unfilled. And by the way, there are very specific guidelines. You actually have to be advertising either online or in a newspaper or somewhere else. There have to be actual ads for an actual job that you need to fill within 20 days or it doesn't count. 4.7% of all of the jobs in the US are vacant right now. This survey's only existed 20 years. The all-time high was 2 months ago at 4.8%. We have 7.5 million open jobs and 5.8 million unemployed people. Now, unfortunately, the unemployed people don't necessarily have the skills for these jobs, but when you look across this survey, the Labor Department has 20 different occupational categories. Every one of them has an elevated vacancy rate. And so I think this is actually quite positive. And what you're seeing in particular, at the low end of the wage scale, the vacancy rates are the highest. Retail, for example, and food services, they can't keep people in the job because the labor market's so tight, they can always find a better place to work for more money. That's good for consumer confidence, consumer spending, and wage growth and employment growth. And last thing on this chart, on the right chart, what you see is the percentage of people who voluntarily quit their jobs. That's, again, grinding higher. The good news there is presumably you only quit your job if you found a better one at higher pay. And again, this is all positive for the consumer, and I believe actually is positive for the economy. Now, one thing people often say, well, don't higher wages mean lower corporate profit margins? This is where it's really important to analyze on a security-specific basis. I mentioned retail. If you look at the wage spectrum in the US, in the last 4 years, people who make $10 to $13 an hour have on average gotten a 20% raise, 20% in 4 years. The people at the 95th percentile of wages who make about $120,000, $130,000 have gotten a 20% raise in 4 years. The middle class, the people who make anywhere from $40,000 to $80,000, have gotten a 10% raise. So I think when you look at companies, if you're, again, in retail or food services, you've got really big wage pressure. And oh, by the way, Amazon's breathing down your neck, too, in certain parts of that. And in the technology sector, financial services at the high end, you've had wage pressure. I do believe that's going to start to equalize over time in the next few years with the middle class getting a lift. So what can go wrong? The biggest worry I had 8 months ago was the Fed. But given that the Fed did a complete U-turn in the last 7 months, and now is basically not talking about raising rates, I think that is a great relief for the US economy. In October and September of last year, I thought the Fed literally was on a path to kill the expansion. I'm very happy that they did the U-turn. What I do worry about is trade. And I want to take a quick pause because I'm going to go into numbers, and I think this is something where economists actually miss the story a little bit. A lot of economists look at trade and say, okay, well, right now, as of 2 weeks ago, we had tariffs on $250 billion of products coming into the US, and the average tariff was 12%. So 12% times $250 billion is $30 billion. US GDP is $21 trillion. You divide any number by 21 trillion, it looks pretty small, and they say, okay, maybe it shaves growth by 10 basis points, 20 basis points. The sad part of that story is we don't buy GDP, we buy corporate profits, and we buy bonds. And I think the impact of the trade fight on companies is much more significant and much more negative than that GDP story would lead you to believe. Point number two, and if there's one point you take away from this where I think I'm more negative than the market, is I believe many people are underestimating the scope of this fight with China. What started as a fight over a trade deficit then kind of evolved into, well, you're not giving us enough market access to compete. And then there was an element of you're stealing our intellectual property. And then it moved into, wait a minute, you have this industrial policy as a country that unfairly steals market share globally. But the real crux of the issue at this point in Washington, D.C. is a national security concern. When you talk to policymakers in D.C., there's a major concern that China is basically advancing so quickly in technology, and that many of those aspects of technology might someday have military applications, that the U.S. needs to shut off their access to intellectual property from our country. And I do believe, by the way, on this chart, we've shown you that we've now threatened tariffs on about $876 billion of products. About $300 billion of that is auto and auto parts. The rest is really China-related. But if I go to the state of play as it relates to China, I really want to drill down on this because to date, the whole story has been, are there tariffs? Is it 10%? Is it 25%? It's easy to kind of quantify. But I want to give you two anecdotes of something that's really changed in the trade front in the last few weeks. And the point of this is really those bottom two bullets. I haven't heard almost anyone talking about these. The Foreign Investment Risk Review Modernization Act, FIRMA, was passed by Congress in August of last year. It vastly expanded the role of CFIUS, the Committee on Foreign Investment in the US. So in the old days, CFIUS basically would only get involved if a foreign company were to try to buy Northrop or Lockheed Martin. It was obviously a national security issue, and they only got involved when it was somewhat obvious. This changed that. FIRMA changed the scope of CFIUS. Just to give you one anecdote from CFIUS, is there's actually a gay dating app called Grindr. It's like the Tinder for the gay community. 3 years ago, a Chinese company bought that dating app. 2 months ago, CFIUS told the Chinese company it's a national security threat for you to own this app. And they're now being forced to sell it. Now, I use that because I never thought I would talk about a gay dating app in a conference. But part two, if a dating app is a national security threat, what in technology is not going to be considered a national security threat? This is a massive scope. Number two, by the way, beyond FIRMA, the FCC 2 weeks ago rejected the application for China Mobile to offer a mobile telephone service in the US. 3 Republicans, 2 Democrats, it was a unanimous verdict that they rejected it. And the commissioners even said, you know what, we already approved 2 other Chinese companies. We should reconsider those applications as well and maybe reject them. So this is not just about Huawei. It's not just about ZTE. This is about any way where a Chinese company could either gain access to personal information that could be used for blackmail, potentially in that dating app site, or as it relates to any kind of technology advance that you could use over the longer term to either use for espionage or for military purposes. And I think the challenge of this issue between that and the Export Control Reform Act, which would limit what companies can sell to China, is it's really difficult to get in front of this and to know what's coming next. And I think this will add volatility to stocks, as you even saw in the last few days as we move forward. Now, China's not the whole story on trade. On autos and auto parts is the other big issue I want to make sure is front of mind. On February 17th, the Commerce Department submitted a report to the Trump administration that basically said that imports of autos and auto parts into the US are a national security threat because they undermine our domestic auto industry. Trump had until May 18th to respond, and he also had the right to extend that deadline 6 months, which he did. So in November, on November 14th, is the new deadline for the White House to decide what they're going to do about this national security threat. Now, presumably, what we're hearing in the media is they're negotiating already with Japan and Europe about how to basically either have voluntary export restraints for cars to the US or basically quotas or tariffs. Now, this is important because we import $300 billion a year of autos and auto parts, and I would note the entire auto industry is opposed to any kind of protectionism in this area because they're worried about reciprocation and they're worried about what it does to their cost. So something else to watch on the trade front. Now, last thing on trade. I do not believe trade on its own is enough to cause an economic recession. But what I'm still trying to grapple with, just full honesty, is how you take these stories and say, okay, what does it do to the mindset of a CEO and CFO? If you're spending all of your time trying to figure out how you move your supply chain out of China, what you're not going to be able to sell in 3 months, how do you think about that? What does it do to your confidence? What does it do to your spending on capital expenditures? Does it make you reluctant to hire people? And how does this snowball? And could it cause a recession if things continue to deteriorate? So I think this is something to keep out of the corner of your eye, or at least on your radar, and keep watching. So let's move to Europe. I think the Eurozone story is also reasonably good. I wouldn't say it's great, neither is the US. US, I'm thinking 2.5% growth this year, 2% next year. The Eurozone, I think, will stabilize between 1.5%. And keep in mind, Europe actually has a structurally lower growth rate than the US. Their population growth is lower, and historically, productivity growth has been lower, so it basically dampens how much they can grow. The biggest risk in Europe, I think, are political risk around fragmented governments, lack of employment growth, and also that Mario Draghi's term ends on October 31st, and we don't know who's going to replace him. So let's go through a few things on Europe. What you see here is economic sentiment basically peaked at the beginning of 2018, and I would just note 2017 was a banner year for European growth. The real economy grew 2.7%, so real GDP grew 2.7%. Net of inflation, well above what any economist thinks is potential growth. So it was a really hot year in Europe in terms of growth. The sentiment peaked right at the end of that year and has basically been coming down since. And the challenge has been figuring out how much of this might be short-term factors versus long-term. And what you can see here, by the way, is just a different element. It's the PMI, or the IHS Market Sentiment Indicator. And again, we gave you different countries. The black line is the Eurozone in total. The line at 50 is the difference between expansion and contraction. And you can see Italy and France are actually right at that line or just below it. So question marks around the growth there. But what I think when you peel back the onion on Eurozone growth, what's really interesting, what we've shown you here are 4 different blocks of data, and each color bar relates to 1 year. So for example, the black bar is 2017. So if you look at the first group of bars, that's real GDP growth on a quarter-on-quarter basis in 2017, and the black bar was 70 basis points. So again, aggregate that up, it's 2.7% for the year. The second block of bars show you domestic demand was about 40 basis points a quarter out of that 70. The third block shows you net exports 30 basis points of the growth in 2017 was exports. Look at the difference between the black bar and the red bar for the net exports. You went from positive 30 to minus 10. That was the entirety of the decline in growth last year. And so that in and of itself could be a positive in that maybe it's a temporary phenomenon. And part of what made us think it might be temporary is when I analyzed the data on industrial production, motor vehicle manufacturing fell off a cliff to some degree in the third quarter of last year. Now, the explanation that I initially thought explained all of this was the European Union passed new emissions regulations last year, and after September 1st, it was illegal to sell any car that had not been tested on the road and in the lab for new emission standards. This was a response to the Volkswagen scandal years ago. And so effectively, every make and model had to be retested twice, and there was a backlog, and basically companies shut down production because you're not going to produce cars you might not be able to sell. So we thought that explained the third quarter, but then the fourth quarter was weak, and we're like, well, maybe the fourth quarter is still the same issue, but then the first quarter has also been weak. And the challenge is Chinese demand for automobiles went from plus 15% year on year in 2017 to minus 10% year on year by the end of 2018. So what's not clear is how much of this might be declining Chinese demand for cars, how much of it might be other factors, and maybe if there's any dangling or lingering issue around emissions. And you can see here when we look at different countries, the blue bars are Germany. So Germany, being more of the auto powerhouse, has been more affected, but the other economies are still a bit weaker than 2018 and 2017. So that's something we're watching. As it relates to monetary policy in Europe, one of the key constraints or one of the key drivers of what the ECB will do is the employment situation. What we've shown you in the gray bars here is the range of underemployment from the first quarter of 2008 through today. And again, remember in the US we have what we call the U6. So underemployment means you're either unemployed or you're working part-time but really want to work full-time. So it's the same kind of metric across countries. When you look at Germany and the US, we're at 7.5%, 7.75%, basically at 50-year lows on underemployment. Go to the left end of the screen. Greece, Spain, and Italy have over 20% underemployment. So by the way, Mario Draghi has one of the toughest jobs in the world. You got to have one monetary policy where in Germany you'd like to be tightening, and in Greece and Italy and Spain you'd like to still be easing. And I do think this is going to lead to very accommodative monetary policy from whoever succeeds Draghi at the end of October. One other thing that helps, by the way, is the black line shows you headline inflation in Europe is still below their 2% target. Just remember in the US we have a target that's symmetrical, so 2.5, 1.5 makes no difference to the Fed. In Europe, the target is at or below 2%, so it's kind of a ceiling that's also a target. But again, we're still below that level. One last thing, this is more for reference. You have a lot of weak coalition governments across Europe, so the only point of this slide is I would not expect any major systematic reforms across the Eurozone because none of these governments are very strong, with potentially the exception of the Italian government, where I think you're likely to have elections again within the next year, which could be a positive catalyst as the League, formerly known as the Northern League, is much more business-friendly than the Five-Star Movement, which is part of their coalition right now. The reason they're in a coalition, by the way, I've used this analogy before. It's like Bernie Sanders and Donald Trump having a coalition government. Both of these parties actually were anti-immigrant, but that's all they agree on. Their economic policies are the opposite end of the spectrum, so I think the League would be happy to punt the Five-Star Movement if they could. And by the way, I left out Brexit, which adds a little complication there as well. So moving to China, I take a different approach to China. I think China is one that's much harder to talk about on a near-term basis because the government manages so much of the economy and has so many levers they can pull. When I think about China, I tend to think of what's the 3 to 5 year forecast. And I believe China is growing at unsustainably high rates at the 6% kind of level. Sustainable growth is probably 3 to 4%, which, by the way, in a country with a shrinking population is still really good growth. So this is not a doomsday call at all. But I do think China's growth will be decelerating over the years ahead, irrespective of trade. The trade may well take 100, 150 basis points off that growth, depending on how bad the conflict gets, but 3 to 4 is the destination. Now, part of my reason, if we take this at a 50,000-foot level, when I think about how much any economy can grow, it's a two-factor equation. Working age population plus productivity equals your growth. So how many people are working and how much do they produce per hour? That's the whole story. Well, these blue bars show you the United Nations forecast, which is that China will continue to see its population shrink for the next 30 years. And by the way, it started shrinking in 2013. This is a result of the one-child policy. They changed it 4 or 5 years ago to a two-child policy, but birth rates really haven't gone up because people don't feel like they can afford a second child. And so this really hasn't changed the story. Now that's part one of the equation. Part two is productivity, and I've got 2 slides on this. This chart is about the aging or the speed of aging in each country. And so what you see on the left end of each bar is the year in which 10% of the population was over the age of 65. And the right end of the bar shows you the year in which 20% of the population is over the age of 65. So the shorter the bar, the faster you're aging. And these are all United Nations forecasts. So just to give you a sense, the United States, the forecast is 59 years. That's probably going to be actually shorter because that assumed a certain level of immigration and birth rates, which have slowed down. Japan, it only took 21 years for the portion of the population to double from 10 to 20% over the age of 65. Luckily for Japan, they were rich when they got old. In the case of China, the forecast is 18 years. Now, there are 2 points here. If you step back and think about yourself, when you were 20 or 25, coming out of university, you probably had a really steep learning curve, right? You come out of school where you think you know everything and you realize you don't know much. You actually start to learn how to deploy your skills in the workplace, and you got that steep ramp. Maybe by the time you're 35, it starts to level off a little bit more, 45 getting a little level. At some age, I won't define it, all of our productivity curves actually turn negative. Just as individual humans, we are not as productive when we get older. And so as a country ages, we should expect their productivity growth to decelerate, if not even decline at some point, depending on technology. Last thing on productivity, the other piece, this is one of these glass half full, glass half empty data points. China has also shifted from being more of a manufacturing export economy to more of a domestic service-oriented economy. This is a natural process. As countries get richer, you no longer basically have to cook all your meals at home. You can afford to go to a restaurant. You might not have your spouse cut your hair. You might go to the barber. I mean, there are things you start doing that you can afford to do which build more and more of those services. So 53% of GDP in China now is a service economy. That's good because it's more domestic, it's more resilient, it's less dependent on exports. The bad part is productivity growth in services is well below that in manufacturing. When I get my hair cut, it takes the same amount of time as 10 years ago. When you buy an automobile, the efficiency of automobile manufacturers has gone up a tremendous amount in the last 10 years. So again, you put those three together at 50,000 feet, that means lower growth for China. Now, there are a lot of drivers that have driven growth in China for the last 30 years, but I want to drill into one more, which is labor. I think China is basically a victim of its own success to some degree. They've gotten so much of the manufacturing power out of other countries, so many of the jobs have moved to China, that wage rates have gone up. Basically, supply and demand have worked. And what you see here is the cost of an hour of industrial labor in urban areas across different countries. So again, urban industrial labor in US dollars. Look at the blue line, which is Eastern China, go all the way to the left. The average wage in Eastern China in 2001 for urban industrial labor was 92 cents an hour. Now, think back then, 2001, you probably paid 20 bucks an hour in Kentucky, if not 25 to 30, depending on union or non-union, or 92 cents. Pretty easy choice if you don't really care about the domicile of your manufacturing. Fast forward to 2017, $6.90 an hour in Eastern China. And by the way, that's 2017. Compounded out to 2019, you're at about $8.90 an hour. So what I think is important here is China has actually been a victim of its own success in that if you're making t-shirts, you're not going to make them in China anymore. You're going to move to one of those lines that are further down, like Indonesia, the Philippines, or Bangladesh, Vietnam. You've got a lot of choices. And oh, by the way, if you have a trade war with the US, you have yet another incentive to move your manufacturing out of China. It gets even worse, by the way. So when we looked at the 31 provinces in China, the one on the far left labeled max is Beijing. The average wage in Beijing in 2017 was over $9. Now it's around $12. So when you look at the rich coastal cities, Beijing, Shanghai, Shenzhen, they're not competing with Mexico or Vietnam. They're competing with Alabama, South Carolina, Portugal, and Spain. And so I think China's almost a story where it's now two economies, a rich coastal economy where people expect high wages. Average couple, by the way, the average first-time apartment buyer in Beijing pays $700,000 for a 600 square foot apartment. I mean, they make 45 grand a year and they buy a $700,000 apartment. So, these are people paying huge multiples of income. But by the way, 45,000 bucks a year in Beijing had never happened before for that kind of couple. Luckily, they have rich parents who pay the down payment because they made a lot of money on property. The big issue I worry about in China, other than losing competitiveness on the labor front, is increasing corporate debt. And so what you've seen over the last 7 years is a big ramp in corporate debt. And I want to point out here, if you think about the Communist Party, they have one objective: stay in power. And the way you stay in power is have social stability, and the way you keep social stability is keep people employed, and the way you keep people employed is make sure companies don't go under and shut down and fire a bunch of people. So what you saw in 2011 is corporate debt in the black part of the bars was 123% of GDP. It's now over 150%. And so what I think you've been seeing is companies that could not repay their old loans get a new one to refinance the old one, and then get another one just to stay open, keep the doors open. Now, in the last couple of years, it's gotten a little bit better, But you've seen a 129% increase in corporate debt in the last 7 years in an economy that only grew 79%. And this is a massive pile of debt that at some point basically could either go wrong if it starts to increase again, or could basically gradually decline if they can keep the clamps down on credit. And to be fair to the Chinese authorities, what you see on the blue line here is they do use credit as a lever. Remember back in 2015, in the first half of 2015, the Shanghai Stock Exchange had a massive bubble. It was a huge rally. And then it burst around June or July, and we had these declines. The government didn't allow people to trade hundreds of stocks. They devalued their currency by 2% in August of 2015. And what you see in that blue line is total credit growth in China went from 13% to 20% in less than a year. So the government said, we can't allow this to happen. The industrial economy was at a recession level, basically, in China. So they turned on the credit, they turned on the government spending, ramped up the growth in lending, and you basically got the economy off its back. By 2017, they said, okay, mission accomplished, way too much credit growth, let's clamp down on the shadow banking system. We don't like what's happening outside of the banking sector in terms of shadow credit. And you see that 20% went down to 10% by 2019. What we're seeing now is as a result of slower economic growth early in 2018, before the trade conflict started, the spigots are coming back on. And so this is something to watch that could become an issue again, but fortunately China is trying to kind of walk that tightrope in a way that will not destabilize global markets. So in summary, I do expect growth to basically be stable to slightly decelerating. US growth 2.5%, Eurozone growth 1%, maybe 1.5%. China can maybe keep 6% this year, but if the trade war gets really bad, we could see a 5%, depending on how much credit they crank into the system. But overall, it's not a bad story. Maybe consider it Goldilocks minus, right? It's not a great story, but it's okay. Now, I do think this is a good environment, though. It's a low growth environment, but actually can be a good environment for investing. So I want to switch to what this all means for asset allocation and where you should put your money in different asset allocation or different asset classes. So just to start off, I think returns on financial assets are going to be lower in the next 5 to 10 years than they have been in the last 5 to 10. It's almost unavoidable. Quick anecdote. S&P 500 up 330% in the last 10 years. 15.5% per annum. If anyone in the room thinks that's going to happen again, I hope you're right. But it's just not going to happen, right? Bonds, it's hard to get much lower unless you're in a deep recession, in which case things don't work. So you're going to have lower financial asset returns. And I think that means your security selection is going to be more important than it has been in a long time. Now, within debt, I am negative on developed market debt, full stop, whether it be government debt or basically corporate debt. And the reason I say that, and I'm going to come back to this in a minute, you're not really getting paid for going out the curve. So let's say you have a bunch of US treasuries. You can earn 2.3% for cash, or you can go out to 10 years and get 2.4%. Doesn't sound like a good risk reward to me. I'd rather just be at the short end of the curve and not take duration risk. Now again, I'll come back to why, because I think the market is pricing in too much dovishness on rates. I'm also going to talk about credit risk. In the US corporate space, I think credit risk has grown a lot. Even yesterday, Jay Powell, chair of the Fed, did a whole speech on leveraged loans. I think he came out a bit too soft on it. I think there's more of an issue in leveraged loans than he's talking about. And that's a place where I'm worried about credit. To be very clear, I'm not ringing an alarm bell about corporate credit. I don't think you need to rush out and sell it. I think over the next 12 to 18 months, though, I would want to be basically decreasing my exposure to the lower quality corporate credits down in the BBB part of investment grade and in the high yield and leveraged loan space. The one part of the debt market I actually think is attractive is emerging market debt. Local currency debt yields 6.5% to 7%. If the Fed, if I look at my Fed scenarios, I think there's a 50% chance the Fed is going to do nothing for the next 2 years. I think there's a 15% chance the Fed will cut rates once or twice, and a 35% chance they raise rates once or twice. In that kind of environment, the currency risk of owning emerging market debt is much lower than it has been in prior years when the Fed was being much more aggressive raising rates. And if you can get 6.5% to 7%, you're getting paid for the risk. Now, given that view on debt, I would be underweight debt. I recognize you all have to have diversifying assets. You all have to have some kind of risk-reducing assets. I would be overweight equities, but I also recognize we're 10 years into an expansion. And again, record-length expansion next month. I don't think we can all be as lucky as Australia, where they've grown for 28 years. And I think you have to be careful. So I do think you want to be overweight equities, but I'll come back and talk about this. I want you to focus on higher quality companies, companies we call compounders, that have high sustainable returns on capital at attractive valuations. Because if the market does crack, if something goes wrong, they tend to defend well. And if you hold them through a cycle, they actually do tend to outperform. So let's go into debt. Why am I so negative on developed market debt? Well, here's the reason. 85% of German bonds have a negative yield. If you buy a 10-year German bond today, you get the pleasure of paying them 8 basis points per year to borrow money from you. 48% of all Eurozone government debt has a negative yield. 73% of Japanese government bonds. Fine. So you're like, okay, we're based in the US, we don't have to own that stuff, move on. I had assumed all these negative yields would keep US rates low, and to some degree they have, but it's important to keep in mind, part of why I'm saying I would be short duration in the US is I think the risk in US Treasuries is that long rates go up, not down. Between Japan and Europe, they own about $1.8 or $1.9 trillion of US Treasuries. By the way, people always worry about, will China sell their Treasuries? China owns $1 trillion. Europe and Japan own 1.8, 1.9. If you're a Japanese investor and you buy US Treasuries, you can see in the gold line a 10-year yield is about 2.4. But if you hedge your foreign exchange risk, your yield is negative 50 basis points. A Japanese investor would be better off buying German bonds with a negative 10 basis point yield than buying a US Treasury if they hedge their FX. Now, some of them have chosen not to hedge their currency risk anymore, which I think is dangerous. And if you're a Eurozone investor and you buy a US 10-year Treasury, your yield is negative 70 basis points. So I look at this and worry that in the next year, we're more likely to see 10-year yields back at 3% than we are to see them at 2%, in spite of the market's views on the Fed. And to that point on the market's views on the Fed, what you see in blue here is the Fed funds futures. So the markets are pricing in a guaranteed 1 rate cut by the end of this year, so in the next 6.5 months, 7 months, and they're pricing in another 1.5 rate cuts next year. So basically, the market has Fed funds back below 2% by the end of 2020. I think this is too dovish. Again, to repeat my probabilities, 15% chance of 1 rate cut or 2, 50% chance of no change, 35% chance the rates go up. And the reason I'm saying that, based on my view of labor markets, I think the unemployment rate in a year and a half could be 3 to 3.25%. I don't see how anyone at the Fed is going to feel comfortable cutting rates when you're at a 70 or 80-year low in unemployment, even if inflation's not coming back. And again, we can dig into this in Q&A because I think there's a lot of nuance around the Fed. I think the market is misunderstanding the Fed and misunderstanding the Fed's concerns right now. There have been a lot of investors who've been talking about the Fed cutting rates as an insurance policy against recession. I don't think the Fed's worried about a recession at all. In fact, I had dinner 2 weeks ago with a former Fed governor who went through all the logic, and their biggest concern at the Fed is that we've grown for 10 years and we can't seem to get inflation. And if our goal is to get 2% inflation, the only way you stay credible with markets is by delivering 2% inflation, and they can't figure out why it's not coming back. They are not worried about a recession at all. They're worried about getting inflation to 2%. And so the only reason I have that 15% chance is because that inflation concern, because the economy is doing fine, and if the Fed basically sits on its hands, it will continue to do fine in my view. I mentioned corporate credit's an issue. What you see here on the left is the growth in corporate bonds outstanding. And what we've used for those percentages in the post-crisis column is since 2009. And this is very important for your corporate or your credit allocations. Investment grade bonds, excluding BBB rated bonds, so everything above BBB in the investment grade stack, have grown by 106% in the last 10 years. The black part of the chart shows you BBB bonds outstanding, so again, just that last level above in junk, have grown by 210%. So when you look at the investment grade universe in the US today, over half of all the corporate bonds are BBB in the investment grade. So when you look at investment grade spreads relative to the last 10 years, and you see that they're right in the range, it's usually kind of comforting. But the reality is the quality of those bonds in the investment grade universe have been gradually going down as more and more of them are just on the cusp of being downgraded to junk. And Morgan Stanley's done some good analysis of this, where they actually assessed that in a minor downturn, you could have $500 billion to $1 trillion of investment grade bonds downgraded to junk. Now, keep in mind, the gold part of the bar shows you the total high yield bond market is $1.1 trillion. Throw a boulder into a bathtub, see what happens, right? If you guys all know, if you're an investment grade manager and you get downgraded to junk, you generally have to sell it. Well, there aren't enough buyers. And so I worry that this is something to keep in mind. I'm not worried about the next 6 to 12 months, but I am worried that over the next couple of years, if something surprises us, this is a vulnerability in the market. The other vulnerability, which is even worse, is on leveraged loans. So high yield is up 87% since 2009. Leveraged loans are up 150%. Why the difference? Well, underwriting and leveraged loans is easier. It's weaker. 85% plus of those leveraged loans are covenant light. By the way, underwriters will tell you in 2008 and 2009, covenant light was okay. It's okay. I have seen this for the last 20-something years in finance. Bankers do this every time. They say, well, last time this was okay, so let's run to the brink and see how far we can go. So no one's going to get it wrong on subprime mortgages this time because we all learned our lesson. But corporates were good, so you can actually take it to the edge on corporates. And what we're seeing here is 85% have covenant light. The other feature, which I recently learned about, is about 25% have a trap door feature. Never heard of it before fourth quarter of last year. A trap door means if you're a company and you basically issue a leveraged loan to investors, in your legal documents, you have the right, legally, to take collateral out of the legal entities supporting your loan and move it to a legal entity that's not supporting your loan. So let's imagine, the proverbial stuff's about to hit the fan, and you say, you know what, I got a valuable asset there. I don't want my creditors to get that. I'm taking it, moving it out of the structure. It's entirely legal, and most investors don't know about it. And so I think you're seeing signs of things going wrong where I'm not alarmed right now, but in 5 years when we look back and say, well, the next recession came, what could we have seen that would have given us a clue? Here's one of them. One more thing, leveraged loans again. When we look at these stated leverage and these earnings add backs and pro forma adjustments, so the way the market tends to talk about leveraged loans is what is your debt to EBITDA ratio? And what you see in each of these columns is the percentage of loans that were issued with certain debt to EBITDA. And as of the first quarter of this year, 62% of all issuance had over 5 times debt to EBITDA. Not such a horrible thing, although please note that's more levered than even 2007, which was the worst we'd ever seen. The worst part, though, is these include earnings add backs. So let's say I'm a private equity firm and I basically buy a company levered up and say I'm going to get $100 million of savings in the next 3 years. That $100 million is included in the EBITDA, even though I haven't earned a penny of it. So the debt divided by a larger number lowers your debt to EBITDA ratio, makes it look safer than it really is. The analysis I've seen shows that it might be 1 to 2 multiples higher than these show, and the Fed told banks not to touch anything over 6 times levered. So again, there's a risk. Moving to equities, they're not cheap relative to history. What you see here is the forward PE for each favorite major market, but they're also not terribly expensive. And again, you look at the US and EM are trading above the 10-year median. Europe and Japan are at or below the median. I just want to point out, if you're looking and saying, well, US is 16 times earnings, everything else is 12, 13, I should sell my US and buy the rest. Look at the return on equity, the return on capital you get out of the US, 50% higher than Europe and EM, 100% higher than Japan. So there's a reason for the differential. And part of that differential is basically just what you buy when you buy a US market. And by the way, when I look at the 2 markets that are most positive to me, I like EM and I like US from a structural composition perspective because I'm getting a lot more technology and communication services. And just remember, Google and Facebook got moved out of tech into communication services, and that's why I refer to the 2 of them. And some of the big Chinese internet companies got moved to communication services. So you're getting more growth potential there. And one last thing in terms of valuation on the last 10 years, again, the US is at the top end of the range, right around the 75th percentile, the top end of that light gray. Europe, UK, right in line with history. Japan is the one market that stands out as being cheap, which might be worth looking at. Now, one last thing I mentioned, if you're going to basically invest in equities and be overweight in year 10 of an expansion, how do you think about reducing risk? I would encourage you to think about upgrading the quality of what you own in equities and think about it as almost de-risking an overweight of risky assets. And we tend to talk about these as being compounders. And what we mean by compounder is companies with high sustainable returns on capital through the cycle that can be sustained longer than investors think and that trade at an attractive valuation. And what we're really looking for here is the key drivers. We're doing a lot of analysis to understand what can sustain those advantages. Are they investing in CapEx, R&D, et cetera, to keep their advantage? And what we did here, by the way, just empirically, is we went back over the last 18 years. Every year we took the MSCI All Country World Index, the 2,400 stocks, rebuilt it, ranked the companies from highest return on capital to lowest, and then looked and said, okay, if you were in the top 10% in year 1 and you stayed there in year 2, what did you do relative to the market? And what these gray bars show you is in almost every year, except 1, you were either in line with the market or ahead of the market by owning the best return companies. It's kind of one of those things, if you think about it, if you ignore the idea that you're buying a stock, if you're buying a business, you want to buy a business that generates a lot of returns and has sustainable advantages. It's a basic investing tool, and we've seen that it works year in and year out. And good thing is you can find these all over the world. You don't have to just do US, you can do international, EM. There are great companies around the world. These are all examples of ones we consider compounders. They cross sectors, with the exception, energy and utilities tend to be a tough place to find these companies because they're so volatile and they're so asset heavy, it's hard to earn a high return. And we also say there are certain kind of features you tend to find in companies that are compounders. It might be that they produce a critical component at a low cost. One of my favorite examples, there's a company in Germany called Symrise. They make the smell in your perfume. So if you're buying a $100 bottle of perfume, the smell might be $2 of it. If someone needs to cut costs, they're not going to change the smell of your Christian Dior perfume. They're going to change the packaging or the advertising. So those kind of examples, or brand, or your technology, or network benefits, there are a lot of features you might want to find. And by the way, they also tend to have very good governance and lower environmental risk, and they also tend to have better social scores. Maybe there's a circular relationship here where their returns are high because of their governance, or maybe basically they have better governance because the returns are high. Hard to tell. So in summary, the overall economic outlook looks good, not great. Returns on financial assets are likely to be lower than in the past, which means security selection is going to be more important, whether it's debt or equities. I do think, by the way, a lot of people have decided over the last 10 years, well, it's a proven fact that you want to be passive. I think you need to reassess that idea and think about it again. Obviously, conflicted view from an active manager, but if you think the U.S. is going to give you 15% a year, then you should be passive. If you believe it might be 5 to 7% like I do, I don't know, picking up 100, 200 basis points of alpha might be really important. For diversification and risk mitigation, I would prefer short duration U.S. If you got the 10-year yield back up to 3, then you might want to go out the duration curve. In the interim, emerging market debt could be a good idea. And I would say avoid reaching out the risk curve in the developed markets for corporate debt because of those factors I talked about. And consider upgrading the quality of your equities through compounders, which do deliver excess returns through the cycle. I've chewed up exactly my entire time allotment, so I apologize for no time for questions, but thank you for your time today.